there are three very important or most important aspects in terms of goals of a wealth management plan. Let's start with growth, because I think this is usually the most important aspect of a financial plan, right? For most people in the audience, most of them have already amassed a large sum of money. They're veterans when it comes to creating wealth and, of course, growing it through their businesses or their professions. For most people, money is going to outlive them. For most ultra-HNIs, a large part of their money will more often than not outlive them. They've got enough money to look after their child's education, their holidays, life post-retirement, education. So these are basic goals for retail investors. But for ultra-HNIs, that's usually looked after. Does that mean they don't actually need to have a financial goal to begin with? Because if your money is going to outlive you, how does it really matter anyway?
See, here you have to derive parallels from a treasury. Right? Of course, the conventional goals for a retail person could be the expenditure of that money. If I can't envisage an expenditure of my money, should I not have goals? I will have number goals. Right? As an HNI, you should have a number goal. Like a treasury will have a number goal. So that's where we would say that your first goal when it comes to rupee is to beat the hurdle rate, which is 12%. 12%, you have to cross 12% to make sure that you're protecting the value of money. Right? And then it is not fun to just protect the value of money. You would want to create something more. If 12 is my inflation, should I at least aspire to have 15, right? Provided it comes at risks which are acceptable. Risks should be acceptable.
See, that's the other thing, right? So for most ultra-HNIs or HNIs or businessmen, I'd imagine, of course professionals are different, they already believe they're undertaking enough risk while running their business, which is fair to an extent. So you tend to start thinking that I'm already undertaking the risk that I'd like to take, because that's why hence I'm a businessman and I didn't choose to become a professional for that matter, because I was willing to take that risk on. If I'm already doing that, is it still advisable to work doubly hard to give it all you have in growing this wealth? Because you're already doing what you can through your day job, I'd imagine.
So, see, unfortunately, risk is a word which has not been converted from English to mathematics for most of us in the wealth management industry. Right? You say that I want to take risks, lower. What is your measure of risk? When you see that the risk measure is not there, then you realize that you are only measuring one side of the coin. Return is the one side, risk is the other side. To be able to understand risk and manage it, okay, that's the key integral part. So like you said, I'm taking enough risk on my business side, on my profession side.
Yeah, I can just let my money be in a savings bank account and I'm fine, because it's anyway going to outlive me, right?
Correct. If it is going to outlive you, the value differential, now for example, if you left for 30 years money at 6.5%, 1 crore becomes 6.5 crores.
Yeah.
Okay, if you left money in a savings account, 1 crore becomes 6.5 crores. If you did and you would get to a 15% number, 1 crore becomes 66 crores. This small difference, which looks like savings account to 15%, the difference is 1 crore getting to 6 or 1 crore getting to 66. So the not taking the risk will become the risk in itself. Because losing 60 crores of opportunity, and this is not castle in the air, right?
Yeah.
You are in the highest growing economy. So identifying opportunities, managing risks lower than the market.
And I think you've got to be smart about your money. You cannot take it for granted.
So
most importantly, which most of us land up doing. You know, Amit, more often than not, and I track the markets on a daily basis myself, and we do personal finance and financial planning. And the number of times you come across products that are a mere distraction, I'd imagine, right? For most people, or for most ultra-HNIs and HNIs, these products get sold to them. It's not what they really need or want. It doesn't fit into their asset allocation. It doesn't fit into their goals. You just buy it because you have an advisor who comes your way who's nice to you, and you sort of feel bad for him and buy the product. Very often than not, this sort of backfires. And what I wanted to help people understand is that the focus should be a lot more vanilla in nature. You got to stick with basics, because that's eventually what creates wealth. It's not going into complicated stuff that's going to help you become a richer person.
I think that's very true. So most HNIs, our belief is, if somebody is an HNI, they're smart enough, and they're very smart in their professional lives and business lives. But when it comes to investing, I think a lot of us lose the basic management approach. And what I've realized is that not just clients, most advisors also are to blame. that we don't help clients set goals, because the moment you have a goal filter, that automatically eliminates 99% of the products in the market. For example, let me give you a simple example. If my return goal today is 12% or 14%, and I can find a mutual fund which can do it. On the other hand, somebody comes up with a venture capital fund as an option, which sounds exciting, all these new startups, last 10 years track record of 40-50% per annum return, and it sounds very exciting. Everybody wants to be part of the new economy. किसी तरह से जुड़ना है new economy में, and participate. Some wealth manager in India was selling shares of US companies like Tesla Motors and stuff like that. And my question is, I don't need 40% return. I'm happy with what the dal chawal is good enough to fill my stomach. So if my goal is clear, then I can eliminate a lot of the products, because that 40% return product or 30% return product also comes with a significant risk attached. And when everything is being considered, being planned, everything looks rosy. Right? And the more complexity that you go down, from an investment strategy perspective, the more risks you take on, which sometimes are not known upfront. So I think having that objective laid clearly and owning that objective. So today if somebody says my objective is 7%, I'm convinced they should only be doing tax-free bonds. Why bother about anything else? But whether the 7% is a sensible objective is a different question. Set the objective and then stick to that objective. And I have realized that all the problems we have in looking at multiple products, this PMS scheme, that AIF, this fancy thing, this this property deal, a lot of these things automatically get cleared if your objective is.
And that's right, because I know of a number of banks or other financial planning outfits. I mean, I worked as a financial planner myself, and a lot of banks do actually have product targets. You have a product of the month. And I think that's where an advisor is usually forced to go to an ultra HNI and push a product which may not actually fit your asset allocation. Also, I think one more thing you need to keep in mind is, while objectives are extremely important and underestimating those is not advisable, overestimating it and being overtly ambitious is going to get you on the wrong foot, right, Amit?
Yeah, so
because that will come enormous amount of risk which no one ever tells us about.
So, we have all sorts of, so sort of taking back to the first question as well, just adding some perspective to that. Some clients are extremely risk averse. Some clients are willing to take extreme risks.
Yeah.
The people who are risk averse, for example, the point that you raised, I'm taking so much risk in business, why do I need to take risk here? The answer is actually very simple. There are different risks that you are completely ignoring. We all know that money does not last beyond 2-3 generations. Businesses have a certain finite life, and it is becoming shorter and shorter with the way the world economy is changing. Professionally, I might not be as smart as my parents, my kids might have a different capability. Beyond 2nd, 3rd generation, what you're trying to do is de-risk their lifestyle as well. Because if we've been fortunate and we have this money, I think we owe it to the next generation as custodians of that money to ensure that it is efficiently managed and not just made risk-free and put into a savings. So that's one extreme. The other extreme is people coming and saying, Amit, I make 25% return ke niche, so I don't see anything. That's the kind of return target, that's what I make in my business. And, which is great. You realize that somebody like Warren Buffett became one of the world's richest men, making around 20% return over a 50-year period. So somebody who is making 25% return per annum, and
so sustainability again.
So sustainability is a big question mark. 25% return over a year, and most clients that I meet are all in their 50s.
Yeah.
Typically when they're in some amount of wealth. Over a 30-year period that they would have been investing, they should have grown their money 1,000 times at 25%, which I've never seen anybody who's grown 1,000%. This maybe grown on the business side.
Yeah,
but on
even that I think most people would agree is extremely tough.
It's extremely tough. So, and equity markets also are tantalizing. Everybody wants to be a Rakesh Jhunjhunwala. But for one Rakesh Jhunjhunwala, there are millions who've failed, right? So there is a survivor bias. So I think sticking to a high probability scenario, so fixing a goal that is reasonable, sensible, seeing is it sustainable, and is the risk that comes with it, like Feroze mentioned, is it acceptable to me? Because most cases we have not even most client portfolios today, if I just do a survey here in the room, how many people have a return objective that is clearly set out? And I will not ask people to raise their hands, but 99% cases there is no clear objective. Second, like Feroze again mentioned, when you ask people, show me a portfolio statement, everyone knows the return. But do they have a numerical value of the risk they have taken to generate that return? Nobody.
And more often than not, unless you're pushed to do it, you're not going to do it. So apart from planning your investments, you need a financial plan to really to get you to sit down and do this, spend some time, take that time out, get your goals in place, quantify that if that's needed. And let's not forget, there's never a free lunch really in life, right? Feroze, I know when I worked with you a few years ago, 5 years ago when I was part of AnandRathi, you all was so bearish on real estate. And at that point, I still remember thinking, I don't know what you're thinking, because at the end of the day, whoever tells you real estate's a bad investment, of course, I'll take that statement back, and I know that real estate hasn't worked in the last 5 years. But do you think it's bottomed out? Do you think it's now time to start investing in real estate? I'm asking you this because most ultra HNIs, beyond the house that they live in, usually have maybe a luxury home, a holiday home, or a second home that's rented out, or the commercial property that they have their offices in, which they usually like to dabble with real estate, if I might use that word. From where we stand right now, I know the last 5 years you guys have got it right. Going ahead the next decade, there are so many asset classes. There's debt, there's equity. 10 years ago, I know art was a big deal, and we all talked about art. 20 years ago, jewelry, so diamonds, watches, luxury bags, if I may say, were considered an investment, right? But from where we stand today, keep it simple. Does real estate have a future? Time to go out and buy a property, or stick with equities, and that's probably the best way to do it.
So unfortunately, when a wealth manager says negative on real estate, it's taken with a pinch of salt, because it's not an area where you would earn money out of it. So, but answering your pointed question, very negative on real estate. We continue to be negative on real estate. Fortunately, now this doesn't result in too many debates, because 5 years back when we said negative on real estate, we would...
now it's the extreme. Should I just rent instead of buy a house? So you just gone from going aggressive on real estate to going completely conservative.
Correct. Why is that? Because there are 2-3 big reasons why real estate will, with a large probability, not go up, at least metro residential real estate. Point one, the supply is enormous. In a country where 40,000 people filed taxes greater than 1 crore. Okay, of course there will be several who didn't file their taxes right. Only 40,000 in 2016 who filed taxes saying that my income is greater than 1 crore. There's 8,80,000 apartments constructed which are at the price range of that, right? So this kind of supply, basic economics says if supply is more and demand can't fulfill that supply, the prices can't go up. Okay, I would want to give away credit of that view to Mr. Raghuram Rajan, who quote unquote said it, only fools will invest in real estate 4 years back. So we said if there is a person with that kind of pedigree and that kind of data is making a statement so strong that it is in a bubble zone now, would I want to be contrary?
Feroze, I just want to, play devil's advocate there, right? A lot of people who've managed to inherit wealth is because of their grandparents or parents, handing over this large property, maybe in Altamont Road. A lot of them in Bangalore have become millionaires overnight because of the property that they owned. So while I know this is a view that you hold, but 20 years later, maybe not the next generation, the generation after as well, you think real estate may not create the magic that it has? Because, real money and real wealth for old school still comes from real estate.
It does, but we have to acknowledge one basic tenet of finance which says base effect. See, 5,000 rupees a square feet becoming 50,000 in 10 years is a certain return. 50,000 becoming 5 lakhs in the next 10 years is the same return. But the chances of 5,000 becoming 50,000 and 50,000 becoming 5 lakhs are very different. That's called the base effect. So Infosys as a stock doubling its earnings is very different than another small stock doubling its earnings. That is called base effect. If you are building your strategy of finance and money without factoring in this concept called base effect. So metro real estate. Now I was just speaking to a client, they said, Raja, Riviera, I have a property to sell at 20 crores for a 4-bedroom apartment. Will this become 80 crores in 10 years? Unlikely. Which is 15% return. If it is unlikely, if it is going to languish at 40, and if your financial portfolio delivered you 80 crores, this decision means 40 crores to you. So you will have to go specific. The country is moving laterally upwards. Mumbai has 602 square kilometers. It has not even constructed that kind of. Hong Kong's FSI is three times. So that means that we will be creating so much more real estate supply by just going to the third dimension of this world. That's the reason why.
I think there are 2 additional reasons. If you see, the pattern of savings. So traditionally the way we left money for our children was to buy apartments. If I live in Bombay, we sort of lived and died in the same city. Our kids also lived, studied, died in the same city. So you would say, I have 2 kids, let me buy 2 apartments. So one way I have saved for my children. But today you don't know whether children will be around in the same city. It has become far more mobile. Your kids are going somewhere else to study. Their businesses, jobs will take them all over the world. And and this realization came 6-7 years back. I was sitting with a client in Gurgaon, and he had large plots of land, and his kids were in the US. And I was saying, "Aap bechoge kaise isko? If tomorrow you are not there, how will your kids sell this land?" They'll call their broker. The broker will say, "Sir, 70% cash." What will they deal with it? Because they will be stuck. People, so
monetization happens and we know what's
so one of course is that people are now saying, let me create liquid wealth which is easily transferable, and there are better ways. So financial awareness is going up. Second was that the whole cash economy in India is structurally is sort of shrinking, right? Demonetization, GST, etc. Now of course it's not been a big change, but there is a change, and there is a big sentiment change, and real estate was supported in a big way by the cash economy. And that cash economy in India, in my view, with the amount of data sort of visibility that the government has in 10 years will shrink dramatically, which means one of the biggest reasons for people to buy real estate, especially outside of Bombay, the more you go outside of Bombay, will be gone.
A couple of years ago, this farmland had become very popular. I know people were buying these, parcels of farmland. They were becoming farmers. I think with Amitabh Bachchan as well do that. That became a very popular way of making investments, small investments where people thought, you could get multi-digit, multiple returns on it. Avoid it, even now?
Again, it's the same story.
It's too complicated.
No, so everyone's trying to saying, iski topi uske sar pe. So everyone was trying to buy land, hoping some developer will come and take it and then plot it and sell it. And a lot of these people, again, we see people who would have bought a piece of land for 40 lakhs, 50 lakhs, today it is worth 15 crores. But there is no buyer. There's absolutely no buyer. Paper. So they have become by default developers. So they're saying, okay, I'm starting to plot the land, cut it. I'm saying you are focused on your professional career or business, and suddenly you're starting to become a developer, and then also take 10 years to sell the project. So, I think real estate, one of the things, point that we missed, is real estate has been a decent investment, but not as spectacular as most people believe it to be. And I think
so we can compare that to equity returns over the last 20 years maybe?
We shared a chart, right? So an average in the last 28 years, from 1990 to today, an average mutual fund investment would have taken you about 250 times. Property in the same period is up 15 to 20 times. There's a huge magnitude. But what happens is, when it comes to property, we all think in multiples. I bought that apartment, it has doubled. It has gone up 3 times, 4 times. We don't think of property as, property delivered 11.8% per annum return for the last 5 years. I have not seen anybody telling me that. But in equity and debt, we're all talking of percentage returns.
You can quantify it.
You don't say my FD has gone up 3x. Right? But when you actually put it on a time scale, so yes, property has gone up 3x, 4x, 5x, 10x. But over what period of time? If it has taken 20 years for it to happen, then what is the per annum return? And that math is surprising to everybody, and it just comes down to doing simple number work.
Right, so we've talked about real estate, so very obviously it's still a negative view on real estate, if anybody is still wondering. But beyond that, Feroze, Amit, either of you can come in on this one. What about the other asset classes? Distraction, you won't spend any time talking about maybe gold, diamonds. I'm sure the women will disagree that gold, diamonds are not a bad investment, but I'm sure you have your wife to disagree with you on a daily basis too. What about debt? What about art? Because I know there are people out there who make investments like these, or a yacht, or a luxury home, maybe somewhere else. Just keep it out, it's not important. Best way to put it.
Yeah, definitely. But before we finish the real estate topic, I think we should highlight one big change on taxation of real estate. Okay, probably it would have gone unnoticed. In the budget of 2016, we have, for all properties which are inherited, our tax liability has come down significantly. For example, there is one client whom I was discussing, a Beach Candy apartment which he is selling at 30 crores, had a tax liability of 6 crores before February 2016 budget. Now the tax liability is as little as 20 lakhs. What is this phenomena? Would the CA have told you? May not have, it would have missed your attention. This is called the base year having been changed. So this base year changing, most of our properties ancestral have got a huge tax discount, and a person after budgets tries to see those small tax benefits, ATC and all these, but this massive tax benefit has gone unnoticed. So you should calculate your tax liability on the property sale before Feb 2016 and after 2016, because if the buyer says I will pay you 10% less, but if you've got a 20% discount on taxation, then I'm still up 10%. That's how transactions will happen if you are not very tight-fisted. So that's section 48. I'm just trying to tell you so that you can do homework and see if it is relevant to you and use it. If you're spending so much time in this, I think you should take away this point. If you have real estate bought before 2001, there is a tax implication change on you, and that could be hugely beneficial in most cases.
Right, so that's what we want to keep in mind. Also, there are sub-objectives now to growth. We've already talked about why growing your wealth is important and what's the best way to do it, which very obviously is going to be more specific to your risk-taking appetite, but largely should be equities. There are a few more objectives. You know, we very often talk about inflation. Now, as a TV anchor, inflation makes absolute sense to me. As a banker, to both of you, that makes complete sense to you as well. But for people sitting in this room, I'm not even sure if they even understand or even track that data point, which of course affects the market on pretty much weekly or monthly basis. What is this inflation? Because when inflation is calculated, it's about the money that is spent on food and fuel. For most people in the audience, food and fuel is not actually even an important aspect of their lifestyle, right? They spend a lot of their money on probably travel, so airline tickets, hotel spends, maybe jewelry, maybe shopping. So there's a whole lifestyle angle involved, right? So when we say 7%, which is a published CPI number that comes out, that is not what your money is getting inflated by, or the loss of value to your money, right? There's far more to that.
Amit, you want to take that?
So, you know, it really comes down to understanding what are we consuming, or what is that money meant for, what consuming what kind of things. And while we don't have access to the kind of data that the government has, and in India a lot of data was not even easily available, but we took, you know, in a lifespan of 30-40 years, as a family, what are the major things we spend on? If you add up all your expenditure, you know, monthly living expenditure, holidays, etc., etc., we figured there are 4 or 5 big items that we spend on. So one, there's a big event in the family, weddings, children's education. You know, most people now want to spend, cost of education has gone up, most kids want to study overseas and people want to send their kids overseas. So for example, cost of US education in rupee terms, the cost has gone up by 13% per annum in the last 25 years. This includes the cost of the tuition fee increase in the US, plus the rupee also having gone down versus the dollar, which also, because at the end of the day, our savings are all in rupees. So that's 13% per annum. You know what?
But you don't even have to look at international education, right? So I have a 2-year-old, and the fees that do the rounds is 15 lakhs a year. And that seems almost normal now, right? So I mean, this is not the kind of fees our parents paid when we went to school.
Costs are definitely going up across, you know, when you're buying a second home, as the family expands, you need more property. Property has been sort of rising at 12%, 13%. Yeah, so but you look at the big ticket items, right? So I don't think cars, etc., beyond the point, a lot of that is what I call lifestyle upgrades. So in inflation, when we're comparing apples to apples, what we also miss out on is lifestyle upgrades. 20 years back, we were all happy traveling in train. Today, nobody even looks at a train schedule. By default, we were saying which flight. People who are flying economy want to fly business class 5 years later. People who are flying business want to fly first class. So there is a lifestyle upgrade inflation also on top. So it is just about putting ahead. And we, you know, when we looked at some of the numbers we put out on the chart, 12% has gone nowhere. 12% is sort of the core inflation that we have faced in the last.
So you need 12% more money
every year
to maintain the same thing, or buy the same things that you're buying from a year ago. So 12%, that's a fair number. So I think any investment bare minimum should be beating 12%, and then we can say it's beaten inflation. You know, we've started this whole event by saying wealth management, wealth, financial planning. What really is wealth? Is it the money in your bank account, or is there more to wealth than just a savings bank account?
So there are 2 ways to sort of, you know, to the connotation of wealth. One is, like Feroze mentioned, to us, wealth is nothing but deferred consumption, which means money saved for some future spending, maybe by us, maybe by next generation, maybe given away to charity, but somebody is going to spend that money, because money by itself has no value. It is deferred consumption. That is one way of defining wealth. The second practical way of when we are actually managing money is to look at what is our wealth, and which is again where we realize that most of us miss out in defining our wealth as a total balance sheet. When we look at it, we look at equities, mutual funds, FD, but I might have some land lying somewhere, I might have some money given to my business, I might have various aspects. So what we do is, let's look at the entire balance sheet. What is the sum total of our balance sheet is our wealth. And that exercise again is something when we ask clients, it takes people several days to put that data together and come up with a comprehensive list of actually what is their wealth looking like.
Feroze,
on the wealth bit, I would like to add. So to summarize, everything other than the houses you consume or the offices you consume has only one purpose of growth. That is your wealth, right? So wealth, when you're speaking to clients, they don't put insurance policies, they don't put their PPF, bringing it all together. And then when I speak to a client, then he says, I never knew all my balance sheet was this much. And so all elements, other than the ones which you have any consumption expectation, those are called aspirational assets in Amit's language. So that's...
Feroze, you alluded to this a few times, and I think in a lot of our shows as we talk about the power of compounding, because really that is where the meat is, right? It's not about getting 25% returns on 1 year and then going down to negative 10% the next year, because that's not going to create wealth for you. Talk to us about why this power of compounding is really where the magic is, because that clearly is the end game.
See, power of compounding is the biggest point in the favor of only those who have time. Fortunately, this group has time, because if you're a retail investor, you don't have time. You have a sword of a goal, which is like 1 year away, 2 year away, 3 year away. When it is generational wealth, then you have the primary driver of your wealth creation as power of compounding, because power of compounding requires time, right? So time is in your favor. Now what happens is, if you have to compound your money, then there has to be consistency in the return. You can't earn 20 1 year and minus 10 another year. Consistency is very critical. So consistency is never there with big numbers. All small numbers have more consistency, right? If you said I have an 8% objective, it is as consistent as it could get. So trying to strike a balance between consistency and having a high degree of probability is important. So power of compounding is a benefit only available to people who have time. And it will be ironical if there are people who have the time, don't use it to your advantage. How does one use it to their advantage? By targeting objectives which are consistent. Then the second way he can use or she can use power of compounding is to manage risk very well. Managing risk is the only thing you can do, because returns are always expected returns. Risks are always suffixed with a word called risk management. To manage risk, you have to measure risk. There are 5 popular methods in statistics to measure risk. Understand them, because if you are managing your money, understanding what are the risk measures, they have become as simple as they could get. Excel sheet has a formula now, right? Like return has a formula, it has. So the second way you can use power of compounding is to manage risks. Because if you don't manage risk, you don't have consistency, you have the time but not consistent return. So just to give you illustration of how you can manage risk is one of my favorite instrument, which was launched by NSE in February 2008, which is called a LEAP, L-E-A-P-S. This actually is an instrument which can mitigate your risk. It is nothing but as good as an insurance on Nifty. If an instrument such that existed, using it or not using it should be a matter of choice. What do I mean by that? The reason I'm using the technical nomenclature so that you can do secondary information reading on Google. LEAPs are nothing but insurance policies. In effect, I'm oversimplifying stuff. If market goes down to half, on the NSE platform, if you have a LEAP, you get compensated for the damage. Just like when I have a car insurance, and if there is a damage of 2 lakh rupees on a car crash, a reasonable portion of that gets mitigated by the insurance company. NSE becomes your platform, and there is somebody else on the other side giving you a LEAP. So power of compounding, time is in your favor as long as you can pursue consistency rather than aspirational returns. Okay, one last point. Like Amit said, there are several products. Now when you look at wealth management, when I was interviewing a relationship manager from another outfit, they said 21 wealth management products are there. We actually banned all of them and said only 2 of them, along with LEAP, can take care of this objective, why would I actually go in the rest of the 18 or 17 which is available? Because data clearly proves, 10-year data clearly says, now private equity funds in India have finished 12 years, the return is 4.6%. Presentations made were 20%, 25%, 4.6%.
Most people here have a financial advisor and have a chartered accountant. A chartered accountant also is a very important aspect for all of us. But I think for an ultra HNI or an HNI, paying your taxes, managing your taxes is also a primary objective, and rather should be, of a wealth advisor, because the amount of money one can save rightfully without cheating the government, and of course being fair to the government, being fair to yourself and your family, you will land up saving a lot of money, right?
Take this.
Either if you can come on that.
So let me give, so tax, like I just mentioned a little while back, has to be a wealth management objective. If you put it down, the chance of meeting it goes up considerably. That has to be the arrangement with your wealth manager. Now let me give an illustration. What is the most popular asset of this country, which has gone into the roots of this country, is gold. Because we have been the largest importer of gold. A person might not have real estate sitting in a rural area, but he will still have, he or she will have some portion of gold. Now, if that objective was wealth management objective, there is an instrument of gold, which in 2015 government came with, which gives you all the capital gains as tax-free. Do people know of that instrument? The answer is no. So if I have gold at 30, if I have gold bars, if I surrendered it to the government and bought a sovereign gold bond issued by the government, which is as good as my money being as safe as it would get. If the gold price triples, you pay zero tax if you hold it for 8 years. So it is this only asset class which is so popular, and if there is another instrument which can make it tax free, if it quadruples, there is zero tax. But if you hold a physical gold, you pay 20% tax. So will this ever reach the masses? It will not, because the wealth advisor doesn't make commission on it.
And
right?
a lot of, I think, banks who have financial planning or wealth advisory don't even treat taxation as a priority or an objective, right?
It's almost an afterthought when taxes are being finalized end of the year.
If it's an afterthought,
yeah,
right?
And there's a rush job. So I think if, and it's fairly commonsensical, but just requires to write it down as an objective and have somebody focus on it. It is fairly simple. But if you can save, 1 or 2 percentage points, and sometimes even 3-4 percentage points every year, it makes a huge impact over 10-20 years.
And especially because the quantum money that we talk about here is very large. So 1-2% in absolute terms translates in a lot of money. Okay, so let's move on and talk about protection, because this is the other thing what I think HNIs land up doing is, you don't keep your business assets separate from your personal assets. God forbid, like you mentioned about your neighbor who was caught on the wrong foot because you're the chairman of a housing society, or a fire in your office, and you as a director, your personal assets come to stake. There's a complete mix-up in our minds between what is yours and what is the business's. Why is the safety net, I think in today's day and age, we can't focus more on it with what we are seeing with NCLTs and so many companies almost going bankrupt. Why are your personal assets very important to be kept separate? Because at the end of the day, it's not your family's problem if you've done something wrong at work at the end of the day, right? Or if you've been caught on the wrong foot.
And I think it's not even about you doing something wrong.
It's just about bad luck.
It's sometimes
we had the fire in Kamla Mills where most of the promoters weren't even responsible.
So I think it's something at a very basic level. India is one of the few countries in the world where we have to give, moment you take a loan, you give a personal guarantee by default. There are very few people who can escape without giving a personal guarantee to a bank, which means all the assets that you have in your personal name are also actually exposed to the risk that you've taken, one has taken in the business side. And sometimes we all ignored it, including the Vijay Mallyas of the world. We all lived in a world where, if there's a bad debt.
Actually, you had a trust, which you want to talk about in the next segment. But
So essentially, how do you sort of create ring fence that wealth from business risks, which are genuine, sometimes are accident risks. And third, there are risks even within the family disputes. For example, how many cases do we know, families where there is one large property which is stuck in a dispute, and there are 5-6 family members fighting, trying to get some developer to take the property, and one of the family faction doesn't have money to live a decent lifestyle, but just then the property bikegi, they will get 30 crores, 20 crores, but they're waiting for the last 25 years. Right? So what is that point of when the money was needed, it is not available. That simple logic, I think, is something that, and there are ways and mechanisms to plan it and systematically create it. And fortunately in India, we can do it at such low cost, almost zero cost, that I don't think there's a reason for somebody not to evaluate it in every family situation.
Right. And I think that's what brings me to mind a very important aspect, which I think AnandRathi has done a good job of, helping clients and customers take estate planning a lot more seriously. So of course we all know that creating wealth, growing it, protecting it are all very important aspects of wealth management. But an equally important aspect is handing all of this wealth that you've created to the next generation. We all want to leave a legacy behind us. Most businessmen want to leave something behind for their children, and for obvious reasons, because you've spent so much of time, energy, and a lot of time creating this. When it comes to handing this to the next generation, putting a plan in place today is probably one of the most important takeaways of this panel discussion, and I think we can't stress about this more, that this is probably and should be one of the most important things we all need to do, right?
Correct, because what happens is there are several reasons, like we said, the money might not reach the next generation very, very easily. Now, for example, the assets, what happens in a normal family? If they lose somebody, they go through an emotional trauma. 3-4 months later, when they have come to terms with that absence of a person who is a dear one, they come and try and figure out what assets does that person own. That bad estate planning is...
I just want to intervene on that one. Even before we go into assets, there could be liabilities as well, which a lot of people may not even be aware of, right?
Correct. There would be liabilities, there would be assets. Of course, once the person tries to discover what assets are there, or liabilities are there, then you start,
might not like,
then you start settling it. Now, India has 28,000 crores of unclaimed money in mutual fund and insurance industry. 28,000 crores is a lot of money. Not knowing whom it belongs to is a resultant outcome of bad estate planning. In fact, you don't even need to die to actually contribute to that, right? So if you actually do an audit, I did an audit on my money and I discovered that my 2.5 lakhs was lost in that 28,000 crores. So today, because of technology, you can see whether any of your money is there. So point one I'm making is, you can discover money in that pool, and if you have not done estate planning in the right fashion, I'm sure people will be contributing to that. So that's one reason why you should seriously look at estate planning. Second is, India had inheritance tax. What is inheritance tax? Inheritance tax is the day I am no more, when I give my money to the next generation, the government says, let me take away 20, 30, 40%. That's called inheritance tax. In India, it was there in a small way till 1994. But in June 2014, Arun Jaitley gave us a discount, which was wealth tax will not be collected from any of us, which was 1% a year he was collecting from us. He said now this will not be there. That was a precursor to bring back inheritance tax, because once Feroze is no more, for example, 20-30 can be collected. Why collect 1% a year? If inheritance tax has to come back, is it important to understand whether you can lock in the current inheritance tax regime if there is a method, fully legitimate method? So there are different reasons why your money might not reach the next generation. I'm sure Amit can highlight the point which he was just mentioning, which is the strategy not getting.
So I think that's the other aspect, right? The software aspect. So all these number aspects people still understand. But let me give an example in business. Today, how does business succession planning take place? We always get somebody in the next generation to come, shadow us, understand, how the business is being run, so that someone can take over the business efficiently and make sure it's a going concern. But on the investment and personal wealth side, usually it's one person in the family who has the 360-degree view. For a lot of people, other people in the family, spouses, kids, it's blank. And which is scary, right? All it takes is to get few people in the room once a year, spend 2-3 hours, explain to them where are all the assets, why have they been deployed in such a manner, what is the thought process, so that there is continuity in the strategy. Because if I know how to drive a car and my kid doesn't know how to drive the car, when I give it to them, it's not going to help. And the time lost till the time they learn and come up to speed and understand, why did my father do this, why did he do this, no, I don't know, somebody else, some uncle, advisor comes in and starts advising. I think it's very simple to get 2 hours in a year in a room together and just make sure that at least 2 or 3 family members know what is happening. That is a very simple way of starting estate planning.
Yeah, and I think on the softer side and keeping it the emotional aspect of it, it does avoid family disputes once you're no more, right? I mean, you talked about how we can't have two kids, prevent them from fighting over a toy. I mean, this is a lot of money and a lot of wealth that you leave behind. So it's more than often going to create bad blood, and you don't really want to leave that with your children or your grandchildren. Also probates, that's the other reason why a foolproof estate plan or your will or trust is actually important, right?
Okay.
Because we hear about enough cases on pretty much everyday basis.
So what's a probate? Probate is nothing but a court order needed to dismantle the assets and distribute it. Okay, we are one of the most complex countries when it comes to estate planning because it is governed by state laws, not one single law. So it's understanding that, for example, if you have a property in Mumbai, probate is mandatory. Okay, might not be the case. So probate is nothing but a court order needed to dismantle those assets. The more the complexity, the later it could get. Okay, it sometimes takes 2 years, 1 year, 3 years to get the probate. If there is an asset which matures, and if you don't know what with, so there are so many instances when a client gets back a check saying an investment check, but the probate is not there, so the demand draft of the investment is lying in a drawer for a year. That's called transmission loss. So if you look at we being as complex as it could get, avoiding or making your will as simple as it could be is important.
Yeah.
Now, for example, if I look at the lawyers who we have for the last 8-9 years internally, who say registering a will is a very good idea, the probability of dispute comes down considerably. But if I ask people, they don't have a registered will. Registration is not mandatory, but having a registered will brings down the dispute probability, and even if it gets disputed, in the court of law it gets settled far sooner. Having a psychiatrist certificate along with your will that the person was of sound mind is a simple thing to do, right? But if you had because this is the reason why they get disputed, right? But if I took a show of hands, there would be only about 2-3 people in a room of a couple of hundred who raise their hand saying that I have a registered will. That's the kind of probability. So please go through this process, and it is a very clerical, not such a pleasant process, and somebody has to.
So it might not resolve, I think, all eventualities, but at least you know you've done your bit to ensure that it's a smooth succession, which is at the end of the day what matters, because all that time and money spent in creating that wealth over the last few decades may mean nothing if your next generation can't have it peaceful. Anybody with questions, bring it on. You've got Amit and Feroze at your disposal.
I am Padmanath Deshpande. I just want to ask, what is your recommendation about asset allocation, because you gave 92% credit to that, so we would like to hear your views about it.
So I think asset allocation is probably the most important aspect once you set your goal. Really understanding for your time horizon, let's say if you got a 10-year horizon, over that 10 years, what are the asset classes and how you want to allocate money. Because what we don't realize and sometimes forget is this saying कि जब market चलता है तो गधे घोड़े सब चलेंगे वरना कुछ नहीं चलेगा. It's impossible to swim against the tide. So, for example, last 5 years, real estate has had a tough time. So, it would be rare to find people who have done well in real estate. And therefore, the asset allocation decision is probably the most important decision, but we end up spending too much time saying which mutual fund, which stock, which property, should we buy before budget, after budget, what will happen to this election result. And enough studies have happened all over the world where they've shown the impact of those decisions over 20-30 years actually cancels out, and it is more luck. But the biggest decision is asset allocation, and which is actually the simplest decision to take. Saying over the next 5-10 years, which asset classes are likely to do, how are they likely to do relative to each other, and you have enough historical data points for you to come to that decision. But if you're trying to do it over 1 quarter, then it's impossible. But really, if you've got a long enough time horizon, asset allocation is probably the most important aspect of creating a plan.
Thank you very much for this opportunity. I'm Jamil Tayyabji. We discussed probates, we discussed wills for transmission of wealth. What we have not discussed is the absence of the will. If you can just throw some light on that, it will be good for the audience.
So, absence of a will of course bring in different laws for different people. Now, if I die without a will, then Sharia law is applicable, and that's a scary one. I'm sure not too many people who follow Islam would want to agree with this, but it's a scary one. Why? Because my wife gets 1/8 of the wealth. Okay, so what happens to the estate when you go, when you leave this world without a will is subject to the Hindu succession law in certain cases. The Islam succession law is called the Sharia law. So it will be concerned with that person and what kind of beliefs he or she comes with. And that is a very, very bad situation to be in, to leave it to interpretations and disputes.
And the other is sometimes when there is no will, suddenly a new will appears from somewhere. So, right.
I'm Dr. Chaitan. I wanted to know, can you rate the asset allocation, because we are in the property investment, real estate and share market also. We have seen all the Harshad Mehta's time and Jhunjhunwala's time going on. So considering today's scenario, what you talk about the estate, about the real estate and about all the equity markets, and how should we balance the things? Because still we have a faith in olden times, like property, real estate is a good initiative, as Samina told. So how will you rate, considering today's scenario in the future 10 years or next 10 to 15 years?
So the first thing that, I think I'll open with what Feroze mentioned right up front is that we tell clients the worst question to ask us when we meet, कि market क्या लगता है, property क्या लगता है. Essentially the first question is, what is my goal and what should my goal be? The moment we've established a goal that we agree on, that this is a return objective that we are good with, this is a risk objective that we are good with, this is a liquidity objective that we are happy with, then the ability to evaluate, because everything has it's suitable for somebody out there. But unless we freeze our objective, we will not be able to come to the right conclusions. So having said that, I think that's the first part that needs to be done. But on a broader scale, I think real estate, and especially residential real estate and land, is going to go through a structural change in India in the next 10-20 years. So I don't see significant upside in real estate, and do I see it beating, even debt returns? I would be happy if it even give a 7-8% return per annum for the next 10 years. I think it's a big struggle because prices are high, supply is massive, the biggest component of demand, cash, is being sucked out. The next generation that is coming through is far more happier doing financial investments. They want liquidity. It's not that we've not done real estate. We did a pre-leased commercial property fund along with Knight Frank back in 2011. But we realized, and the fund did well, but we realized it took us 12, 18 months sometimes to exit properties. Now the cost of holding on for liquidity, where you saw that the markets are doing well and we want to exit this property and move it to markets, we could not for 12 to 18 months. So these are choices that one has to. So there are pockets in real estate which might be interesting, but I think it comes back to saying, what is my goal? And is it the best vehicle to, the macro outlook, at least from our perspective on real estate, is fairly, I would say, neutral to negative at this point of time until we see, because India is one of the few countries where HNIs have 50, 60, 70% of their net worth in real estate. Globally, that number is 15, 20%. So something has to change. Either the entire world, which has had hundreds of years of savings history, they start moving into real estate, or Indians start giving up real estate and start moving into financial assets. Not necessarily equities, but it could be debt, but basically financial savings.